Well, good morning or good afternoon, everyone, and welcome to Money Corp's November Market Pulse webinar. I'm Neil Parker, and I'm Head of Economics and Market Strategy here at Money Corp, and I'm delighted to be your host today. A lot's happened in November, and over the next 20 minutes or so, I'll run you through what's happened and how that's affected our thoughts and forecasts for the remainder of this year and the year ahead. During the session, you won't be able to use audio or video, but you will be able to post your questions into the chat box, and I'd encourage you to do this throughout the session, and I'll try and get to as many of the questions as I can at the end. But without further ado, I'll go into the presentation, and it's certainly been an interesting time since the last webinar. So we've had a continuation of the US shutdown, but an eventual end to it. So I'll be discussing what that means and also what we might be getting into 2026. Will we be getting a repeat? We'll look at inflation and what that might also mean for interest rates. Will the Fed be cutting again in December? We'll look at the labour markets and unemployment for the major economies that you're interested in and seeing how they're developing and what that means for their own domestic policy. We'll look at geopolitics because we've seen some events that have blown up since the last call, ones that weren't necessarily expected, and how that might affect the US and other major economies. And then finally finish with some FX market forecasts and a summary of our current thoughts. So as far as the US shutdown is concerned, well, it came to an end after 43 days. It came to an end on November the 12th, and it's been the longest shutdown in modern US history. Now, what was agreed was not a comprehensive package of spending measures, nor indeed something that would see us through until the end of next year. In fact, it only runs until the 30th of January before the whole thing will have to be renegotiated, or rather it will have to be renegotiated before that time so that the US government doesn't go into shutdown once again. Now, the problem with the negotiations this time around will be the same problem for negotiations next time around, and that is that there are significant policy differences between the Democrats and Republicans over spending priorities. And as a consequence of that, I think that we will most likely see the same sort of problems reemerge when we get to the end of this year or into early 2026. And also, there's another wrinkle in this particular issue, which is that there are midterm elections due in November of next year. And I think that this may well be a backdrop against which both sides, the Democrats and Republicans, are trying to politically point score in order to make the best possible progress in those midterm elections. But there has been some good news as far as the US is concerned, which is that inflation's heading in the right direction. And also we saw weaker Canadian inflation as well. And I think that's positive news because nobody's really expecting any additional rate reductions from the Bank of Canada, whereas they're expecting several from the Federal Reserve. But I do think that the most recent inflation numbers and the downward move in core inflation is positive as far as the prospect for additional rate cuts from the Bank of Canada. We've also seen some falls in Mexican inflation as well, and that could lead to additional cuts from Banxico, or the Mexican central bank. And the Brazilian inflation figures as well, they're considerably below where they peaked. Consequently, I think that we could be seeing the Brazilian central bank cutting interest rates throughout 2026 to be considerably lower than where they currently stand at 15%. And looking at interest rates, although the markets now believe that the Federal Reserve won't cut interest rates in December, it was only a week or so ago that the majority of forecasters and also the majority of the markets were anticipating an interest rate cut from the Federal Reserve. So I think there's still quite a lot between now and the December 17th meeting to give us more clues as to whether the Federal Reserve will reduce interest rates. I don't believe it's either a done deal that they will cut or that they won't. I do believe that this will be data dependent, as we've been told repeatedly by multiple Federal Reserve officials. As far as the Bank of Canada is concerned, I would be very surprised if they cut interest rates between now and actually the end of the first quarter of next year. But there are signs and signals from the Canadian economy that things are still not running smoothly. Economic growth isn't as strong as it really ought to be. There are other problems as far as the labour markets are concerned, even though headline numbers out of Canadian employment figures suggested strength. Actually, that was all due to part-time employment, which could have been cyclical, whereas full-time employment is still falling. So there is still a risk that the Bank of Canada cuts interest rates, and I don't believe that's factored in to current market thinking. In terms of the European Central Bank, which might be of interest to some of you, I think that they could continue to cut interest rates further as well. Some announcements out between the last call and this one, which seem to indicate that there could be a more sizable downward risk to inflation versus target over the course of next year and into 2027, particularly things around emissions trading and a scheme that was meant to be introduced at the beginning of next year, whereas it looks as if it's been postponed for another year thereafter. So that could cause some medium-term downside risks to consumer price inflation figures. And then finally, if we look at Latin America and the likes of the Mexican Central Bank or the Brazilian Central Bank, interest rates do look as if they are going to head lower. In Mexico, I think that will probably come as early as the December meeting. For Brazil, it might take a bit longer. We might be talking about first quarter of 2026 before those cuts start coming. But Brazil is likely to cut more aggressively in terms of the size of the cuts than we're likely to see out of the likes of the Federal Reserve or the Mexican Central Bank. Unemployment is another interesting thing. I mean, we've just had the labour market data out of the US, albeit for September, so I'm not sure how much of interest that was to markets. But the labour market had previously, prior to the shutdown at least, been reporting a weakening in labour market demand. I think that's still really in existence in spite of those September figures. It's showing rising unemployment. By the way, in spite of the improvement that we saw in non-farm payrolls, we still saw a rise in the unemployment data. And the other thing is that we're seeing other effects. So we're seeing a general weakening in average earnings growth, which would suggest that supply is outstripping demand. So that, for me, is something that I think we'll keep an eye on as far as US Federal Reserve policy is concerned. And whilst I think that the markets are still too optimistic about the number of rate cuts that the Federal Reserve are likely to sanction, I wouldn't be surprised if these labour market data will determine where eventually US interest rates will fall to. As far as Canada is concerned, those unemployment figures, again, were a mixed bag. I still think that unemployment in Canada is a major challenge, and an overall weakness in underlying demand is a big problem for the Canadian economy. And that may well be reflected in a further increase in unemployment rates over the course of the first half of 2026, which would clear the way for additional easing should the Bank of Canada see fit. In the euro area, I think I would say that the unemployment rate has been pretty stable, albeit that the recent falls that we've been seeing until a month or two ago appear to have stalled. And then if we look at other areas like Brazil and Mexico, Brazil's been seeing its unemployment rate falling. Mexico, their unemployment rate actually might be on the rise again. And that would be another reason why we could see Mexican interest rates fall, not just into the end of this year and the first quarter of 2026, but further rate reductions throughout the remainder of 2026. So keep an eye on all of these. I say keeping a watching brief as far as the headline of this slide is concerned. The reason I say that is because I think that could be a key determining factor in interest rate cuts, much more so than where inflation rates tend to land, because I think inflation does look as if it's continuing to push lower over the course of next year. As for geopolitics, well, I talked last time about problems in the Middle East and problems in Russia and Ukraine and other problems in parts of Latin America and particularly with regard to Argentina. And then finally, I talked about the ongoing tension between China and Taiwan and China and the rest of Asia. But another one has come to the forefront over the last 4 weeks or so, which is the Venezuela-US crisis. The US has been conducting strikes on what they suspect to be drug trafficking vessels over the course of recent months. They appear to have stepped that program up in recent weeks. And not only that, we've seen messaging from the US government that suggests that they hold Venezuelan President Maduro responsible for a lot of that drug trafficking, actually naming him as a leader of one drug cartel. And consequently, that has led to something of a crisis between the two nations, one that may be coming to a head because the president has now requested face-to-face meetings with the US. But I would worry that what we're seeing between the US and Venezuela might be replicated between the US and Mexico. We know that there have been ongoing issues with regard to drug trafficking out of the Mexican nation, and something that's been referred to repeatedly by US President Donald Trump. So there are problems geopolitically that could then be a factor as far as how the financial markets trade, and particularly the FX markets, might react negatively for the likes of the Venezuelan currency or indeed the Mexican peso. So just again, keep an eye on this alongside the labour market data. And then finally, before we get to the summary slide, at least looking at FX forecasts going into year end, I've been more encouraged by what I've seen as far as the US dollar is concerned of late. I've definitely seen some recovery there, and that's in spite of the fact that the US administration continue to say that they don't want to see the US dollar strengthening disproportionately, at least from an economic activity perspective, to other currencies. Now, a lot of the currencies on here I don't think really matter that much to the US administration. The big one that matters isn't even on this particular slide, which is the Chinese renminbi. But overall, if you look at the progress that we're likely to see in euro dollar or dollar Canada or dollar yen for that matter, then I would suspect that you're likely to see only limited additional gains as far as the US dollar is concerned. But I do think that that is the risk. And it's the risk because I would anticipate that the US economy will continue to outperform the vast majority, if not all of the all of the countries or economies that it's stacking up against. It's certainly performing better than Europe at the moment, or the euro area. It's performing better than Canada. It's definitely performing better than Japan, which has a lot of domestic and also geopolitical problems of its own. Although there are better performances in terms of headline economic growth from the likes of Mexico and Brazil, they do have additional problems with regard to the trade position that have been well highlighted in the previous webinar. So I think that the dollar is set to make limited additional gains. It might actually make more gains against the likes of the peso and the real than it does against the Canadian dollar, the euro, or the Japanese yen. We'll keep a watching brief on this. We've marginally adjusted our forecasts here. We still see the predominant move here being dollar strength into year end and into the year 2026. So if we look at a summary of what our thoughts are, well, thank goodness the shutdown is over, at least for now. I think the rate cut risks that there are out of the US probably a little bit overstated, and Jerome Powell and a certain number of his cohorts at the Federal Reserve have emphasized this. Inflation's heading in the right direction, but it might still need an additional nudge lower. And so it might need interest rates to stay higher for longer than is priced in by the financial markets. The US labour market is loosening. I think that that's part and parcel of a lot of the policy measures that have been enacted by the current administration, but it's also the fact that they do have interest rates that are too high and need to come lower, albeit that they will come lower slower than the market's anticipating. We'll highlight the fact that Swiss franc is now at its highest level since basically the time when we saw the currency peg end between euro and Swiss. There are quite a lot of safe haven flows still going on there, and I'd expect that to continue. You've only got to look at things like gold and gold prices, and that continues to perform very, very strongly. And that gives you an indication of why the Swiss franc remains robust. But the US dollar does look as if it's going to set to end the year more positively, certainly more positively than it did throughout the beginning, first sort of 4 or 5 months of this year when the dollar sold off fairly aggressively. So it's made some headway back. It's made some gains. That's all good news, and I'd expect to see the dollar ending the year on a positive note rather than ending the year on a bit of a duff note. Because I think their economy does look still in better shape than a lot of the counterparts, a lot of its major competitors. So thank you very much, and that's the end of the presentation, but we do already have some questions that have come in. So we're going to go to the Q&A. First question is, where do you see the low in US dollar interest rates? Which, great question. I'm not going to be able to answer this with an exact number. I'm going to give you a bit of a range because I think it's probably going to be somewhere between 3 and 3.25. I know, having looked at some of the comments that we've seen from the likes of deputy governors or other important members of the Federal Reserve, that there's a huge range that they're suggesting. But I think that we're closer to the bottom than a lot of those forecasts predict. So I think somewhere between 3 and 3.25 is the likely low for US interest rates in this economic cycle. The next question is, with the US dollar now trading higher against the Japanese yen, why isn't the Chinese currency? And I think this is something that ultimately I've been asking myself quite a lot. I don't understand why the Chinese currency is holding up as well as it is, unless it is a strategic policy from the People's Bank of China under the sort of guidance of the US Treasury. It would appear to me that if you looked at this from a fundamental perspective, particularly if you look at debt and deficit levels that China is printing at the moment, it just makes no sense. I would suspect that dollar China ought to be trading closer to sort of 730 or 740 if you had any modicum of skepticism about their growth numbers, which don't appear to make any sense, and B, their ability to finance the deficits that they're currently printing. And the Japanese yen movement would suggest that we should be trading somewhere around sort of 730, 740, in my opinion. So I don't think the Chinese economy is doing that well. And I do think the Chinese currency is vulnerable to weakness throughout 2026. So a very good question from our audience. What are the risks of a repeat of the recent shutdown when funding runs out in January? Excuse me a second, I'm just going to take a sip of water. Mainly to give myself time to think about the answer for that one, because although the shutdown that happened, I think both sides have been chastised by that. However, I think there are such significant gaps that remain with regard to both the Democrat and Republicans' position. I'm not sure how they can be closed between now and year end. And then you get into a period of risk as far as the US government is concerned, where the Senate won't be able to agree. So whatever the House of Representatives maybe sign off on It'll go to the Senate, and I'm not sure they'll be able to agree those policies. Consequently, the risks are very high. And I would suspect that from the perspective of another government shutdown, although I would hope it doesn't happen, at this moment in time, I think it's more likely than not. So in terms of other questions, we're just having a look here. I don't think we have any further questions, I'm afraid, which is a bit of a shame, but never mind. Thank you very much for all dialing in today. Now, I've got a bit of a plea, or several pleas actually. One is that if you're not already signed up to our daily market pulse and you'd like to be, that's a way of automatically being included on these webinar invites, then please make sure that you do. We're going to share with you a copy of the recording shortly. If you'd like the slides, then please reach out to your usual Money Corp contact. We'll make sure that you get those as well. More importantly, if you'd like to have a discussion with us over some of the topics that we've spoken about, perhaps some of the forecasts that you've seen, then again, reach out to your Money Corp contact. Or if you don't have one, then reach out directly via the contacts that you see on the screen below. And my final plea is you're going to receive a short, and believe me, it is a short feedback form. Please fill it in. Tell us what you like. Tell us what you don't like. If you can spare 5 minutes, it would be tremendously helpful, because that means that we will be able to tailor the next webinars to what is going to be of interest to you. I hope you've been interested and intrigued by everything that you've heard today. You may not leave more optimistic, but hopefully you'll leave more informed. And feel free to reach out to us either on LinkedIn or through the channels that you had provided to you. But thanks very much for dialing in. The December webinar, I can't guarantee will be more optimistic, but it will be equally interesting. So I look forward to speaking to you then. Thanks very much, and goodbye.